Four of the market's most watched names reported this quarter, and by every headline number, they should have all been up. Microsoft beat. Meta beat. ServiceNow beat. SoFi beat. Revenue, every single time, came in above what Wall Street was modeling. And yet only two of those four stocks went up. Meta made $60.8 billion in 3 months, more revenue than most companies see in 5 years, and investors sold the stock anyway, sending it down as much as 9.5%. So what actually separated a stock that got rewarded from one that got punished, when the top-line story looked almost identical? This is the earnings deep dive for the week of July 29th, 2026. Microsoft, Meta, ServiceNow, and SoFi, results, commentary, guidance, and capex, and what it all means for the sector heading into the back half of the year. We'll move results summary, then sector mood, then company by company. Quick housekeeping before we go further. Everything here is for educational and entertainment purposes only, not financial, investment, legal, or tax advice, and I'm not a licensed financial advisor. Investing involves real risk, including loss of principal. Every opinion here is my own, may change without notice, and the responsibility for any decision you make sits with you, not with this video. Third-party content is used under fair use for commentary, criticism, and analysis. My job for the next while is to hand you the clearest picture I can build from company filings, earnings calls, and financial press coverage. Your job is your own homework, and ideally a conversation with a qualified professional before you act on any of it. Now, let's get into the numbers. Here's the one-slide summary, because it tells you almost everything before we go company by company. Microsoft fiscal 2026 fourth quarter, $90 billion in revenue, up 18%, and a clean beat of the roughly $87.6 billion estimate, $4.74 in adjusted earnings per share against an estimate of $4.24. And the stock rose 8% after hours on a fiscal 2027 capex guide of $255 to $260 billion. Meta, second quarter, $60.8 billion in revenue, up 28% and a beat of the $60.2 billion estimate, but earnings per share of $6.18 missed the $7.23 estimate by double digits. And the stock fell 11% after hours as full-year capex was raised again to $130 to $145 billion. ServiceNow, second quarter, $3.99 billion in revenue, up 24% and a beat, 90 cents in earnings per share against an 86-cent estimate, and the stock rallied more than 4.5% intraday as full-year subscription revenue guidance was raised to $15.76 to $15.78 billion. And SoFi, second quarter, $1.2 billion in adjusted revenue, up 40% and a beat of the $1.11 billion estimate, 12 cents in adjusted earnings per share against an 11-cent estimate, and yet the stock fell anywhere from 5.7 to 10%, even as full-year revenue guidance was raised to $4.75 to $4.85 billion. Side by side, here's the checklist. On revenue versus the street, Microsoft beat, Meta beat, ServiceNow beat, SoFi beat. A clean sweep. On EPS versus the street, Microsoft beat, ServiceNow beat, SoFi beat, and Meta missed, the only name of the four that came in light on earnings per share. On guidance, Microsoft raised its Azure outlook. ServiceNow raised subscription guidance for the second time this year. SoFi raised revenue but held earnings per share flat, and Meta issued a light third-quarter guide. On spending, Microsoft's number looks high but was eased on paper through an accounting change. Meta raised its capex floor for the third time this year. ServiceNow is facing rising sales and marketing costs. SoFi is facing real margin pressure. And the stock reactions tell the real story. Microsoft up 8%, Meta down 7 to 9.6%. ServiceNow swinging from an initial dip to a gain of 4.6 to 7%, and SoFi down anywhere from 3 to 10%, depending on the session. Every one of these four companies beat revenue. Only two saw their stock go up. The differentiator wasn't growth. It was whether spending discipline matched the story management was telling. Before we go deep on each name, it's worth pulling back the headline numbers, because none of these four are doing anything close to an accounting violation, but each one flatters its own top-line story in a way worth knowing. Microsoft's EPS beat leaned partly on a $3.2 billion unrealized paper gain on its Anthropic stake, worth about 27 cents a share on its own, and its widely reported capex cut to $175 billion partly reflects extending data center useful life from 15 to 25 years and reclassifying new leases as operating rather than finance, both of which reduce reported spend without reducing real spend. Meta's roughly $27 to $30 billion Hyperion data center is financed through a special purpose vehicle 80% owned by Blue Owl Capital, debt and leverage that never appear on Meta's own books, and free cash flow still collapsed 91% to $784 million, arguably a bigger warning than the EPS miss itself. ServiceNow's CFO, Gina Mastantuono, confirmed roughly half of this quarter's beat came from U.S. federal revenue pulled forward from the third quarter, amplified by a July 1st pricing change that triggered early renewals. A beat partly borrowed from next quarter, with third-quarter guidance already pricing in a hangover. And SoFi's loan platform business recognizes gains up front when it sells originated loans to institutional buyers, an originate-to-distribute model. Healthy capital ratios today, but revenue quality that depends entirely on institutions continuing to buy that paper. Here's the backdrop every one of these four results is sitting inside of. Full year 2026 capex guidance, top of range, across the four biggest hyperscalers. Microsoft at $190 billion, Meta at $145 billion, Amazon at $200 billion, and Alphabet at $205 billion. Combined, that's close to $740 billion across just these four names, up sharply from 2025 as GPU, memory, and data center buildouts race to keep pace with AI demand. Component cost inflation in memory and servers, along with real data center capacity constraints, are cited by both Microsoft and Meta as reasons guidance keeps moving higher through the year. And here's the shift worth noticing. The market is no longer rewarding capex increases uniformly. It's rewarding capex paired with visible revenue and monetization proof. Microsoft, ServiceNow, and punishing capex that outruns near-term cash generation, Meta. That's the single biggest swing factor behind every one of this quarter's stock reactions, bigger than the revenue beat itself. Two sector read-throughs before we get to company deep dives. First, semiconductors. The arms race is the swing factor, not revenue. AI capex guidance is now the single biggest driver of megacap reactions, bigger than the revenue beat itself. Chip names, NVIDIA, AMD, Broadcom, Micron, Applied Materials, had wobbled into this earnings week on capex cut fears, then rallied once Microsoft and Meta both reaffirmed, and in Meta's case raised, their AI infrastructure spending. Micron, AMD, and Lam Research all jumped double digits the very next session. Watch NVIDIA, Broadcom, AMD, TSMC, and Micron's own prints next for confirmation the cycle is still intact. Second, neo-cloud and private credit. The balance sheet itself is becoming optional. Microsoft's lease accounting reclass and Meta's off-balance sheet Blue Owl and Hyperion special purpose vehicle are becoming the blueprint other hyperscalers and neo-clouds. CoreWeave, Nebius, Oracle are following to fund GPU buildouts without the debt ever showing up on their own books. The buyers on the other side, Blue Owl, PIMCO, BlackRock, are the same private credit engines increasingly financing consumer and corporate debt elsewhere. If the AI capacity build ever outpaces demand, that leverage doesn't disappear, it just isn't visible on the hyperscaler's own balance sheet. Two more sector read-throughs. Enterprise software's bar just got higher. ServiceNow proved this quarter that AI monetization can be real and immediate. $1 billion in AI annual contract value. Agentic deployments up 9 times in 9 months. That's a green light for Salesforce, Palantir, and Workday to show similarly concrete AI attach numbers when they report or face the same SaaS-apocalypse skepticism ServiceNow itself walked in with. The bar for We Have AI too just moved from a slide to a number. And consumer fintech and banks. Growth alone no longer gets a pass. SoFi's flat earnings per share guide, despite a genuine revenue raise, is the same story likely to play out at Affirm and Upstart. Investors are grading consumer lenders on margin discipline for the first time in years. SoFi's originate-to-distribute loan platform business puts it in the same conversation as the private credit funds financing AI data centers. Both are moving credit risk off balance sheet and into institutional hands, betting buyer appetite stays strong through the cycle. Let's start with a name that got it right in the market's eyes. Microsoft, fiscal 2026 fourth quarter, the quarter ended June 30th, 2026, reported July 29th. The stock rose 8.9% after hours. Azure blew past its own guidance. Copilot seats crossed 30 million, and management leaned directly into a 35% capex step-up for fiscal 2027. The market's clearest AI spend is paying off verdict of the entire earnings season. CFO Amy Hood put it plainly on the call. Demand continues to exceed available supply. The numbers, against a street consensus of roughly $87.6 billion in revenue and $4.24 in earnings per share. Total revenue, $90 billion, up 18% year over year. Adjusted earnings per share, $4.74, up 23%. Microsoft Cloud revenue, $59.3 billion, up 27%. Azure growth, 43%, against a guide of 39 to 40. Commercial remaining performance obligation, $678 billion, up 84%. Capex plus finance leases, $41 billion, up 69%. Underneath those headlines, operating income hit $40.6 billion, up 18%, and GAAP net income reached $35.8 billion, up 31%, boosted in part by that $3.2 billion gain on Microsoft's AI Lab stake. The Intelligent Cloud segment did $34.7 billion, up 30%, and annual Azure revenue surpassed $100 billion for the first time ever, with annual Microsoft Cloud revenue crossing $214 billion. Copilot paid seats crossed 30 million, up from just over 20 million in April, and GitHub Copilot now has 50 million users. The overall AI business's annualized revenue run rate exceeded $37 billion, up 123%, the clearest current proof that AI spend is converting to booked revenue. The one soft spot, more personal computing, Windows, Xbox, Surface, Bing, fell 4.4%. Reminder growth is uneven across the portfolio. On guidance, Azure's next quarter outlook calls for roughly 45% constant currency growth, accelerating, not slowing. Total revenue for fiscal 2027's first quarter is guided to $89.85 to $90.95 billion, 16 to 17% growth. And here's the capex trajectory. In Microsoft's own numbers, fiscal 2026 actual spend came in around $116 billion. The calendar 2026 outlook was trimmed to roughly $175 billion, down from $190 billion guided back in April, and fiscal 2027 is now guided above $255 to $260 billion. Call it $258 at the midpoint, up roughly 35% year over year. That so-called capex cut is partly an accounting move, not less real spending. Microsoft extended the useful life of data centers from 15 to 25 years, lowering depreciation, and reclassified new data center leases from finance to operating treatment, both of which flatter the reported 2026 number. The fiscal 2027 guide of $255 to $260 billion tells the truer story. Spending is still climbing hard. On the call, Satya Nadella tied results directly to growing enterprise demand for cloud and AI, naming both the Azure $100 billion milestone and the 30 million Copilot seat milestone specifically, and framed the strategy around giving enterprises their own learning machine, AI models, as an input to a firm's own knowledge base, not an extraction of it. CFO Amy Hood noted that nearly 90% of Microsoft Cloud revenue now comes from customers outside the frontier AI labs, a deliberate data point pushing back on growth as all OpenAI concerns, and pointed out that sequential RPO growth was driven by commitments from customers other than AI model developers, another concentration risk offset. On capex specifically, fiscal 2027 spending is guided to roughly $255 to $260 billion, a 35% step up from the roughly $190 billion spent in calendar 2026, the largest single guidance number of the entire quarter. Operating margins are guided down slightly in fiscal 2027 on continued AI infrastructure and R&D spend, and Windows OEM revenue is guided down in the high teens for the year. Despite the capex jump, shares rallied. Microsoft was the only megacap this cycle whose capex number moved in the direction the market wanted. Why? Azure growth of 43% beat its own guide despite real capacity constraints, meaning demand is visibly outrunning supply. So incremental capex reads as revenue-backed, not speculative. Contrast that with Alphabet, where raising 2026 capex guidance twice this year sent shares lower. Microsoft's raise, paired with a beat-and-raise quarter, was read as confidence rather than concern. What does this quarter tell us going forward? On the tailwind side, Azure capacity is the binding constraint, not demand, about the best setup a hyperscaler can show. Enterprise AI monetization is genuinely inflecting. Copilot seats up 50% since April. AI run rate up 123%. Cybersecurity and Dynamics AI cited by name as adoption drivers. And revenue diversification beyond frontier lab customers. 90% of cloud revenue de-risks the single customer concentration bear case. On the headwind side, fiscal 2027 capex up roughly 35% to $255 to $260 billion will push depreciation higher right as margins are already guided down slightly. Those accounting changes flatter near-term optics without reducing the actual cash committed, and power and chip supply remain real ceilings on how fast Azure capacity, and therefore revenue, can grow. The sector read-through is positive for GPU and AI chip suppliers, power and data center infrastructure names, and Copilot-adjacent enterprise software, and it meaningfully undercuts the AI capex's peaking thesis while raising the bar for Amazon and Alphabet to show similarly demand-backed spending. Watch fiscal 2027's first quarter in October for Azure capacity commentary and any OpenAI or RPO concentration disclosure. Continued beats look likely if capacity constraints ease, but the market will start discounting future capex raises the way it already does Meta's. Now the other side of the same AI supercycle. Meta Platforms, second quarter 2026, quarter ended June 30th, reported July 29th. The stock fell roughly 11% after hours. Record ad revenue met a record capex bill, and free cash flow collapsed from $8.5 billion a year ago to just $784 million this quarter, as Mark Zuckerberg's AI infrastructure and superintelligence bet consumed nearly all of the quarter's profits. Meta made $60.8 billion in 3 months. Wall Street sold the stock anyway. Against a street consensus near $60.2 billion in revenue and $7.23 in earnings per share. Revenue came in at $60.8 billion, up 28%, a genuine beat. Earnings per share landed at $6.18, down 13% and a clear miss. Operating margin fell to 31% from 43% a year earlier. Quarterly AI and data center capex hit $31.1 billion. Free cash flow, the number that actually spooked the market, was just $784 million, down from $8.5 billion a year ago. Daily active people across the family of apps reached 3.6 billion. Underneath the headline, revenue beat by about $620 million even as EPS missed by 14.5%, and that shortfall came entirely from cost lines. Capex-driven depreciation, $2.4 billion in legal charges, May 2026 severance, not from any weakness in advertising. Operating cash flow was actually healthy at $31.9 billion. Nearly all of it was simply absorbed by that $31.1 billion quarter of capex. Engagement itself kept climbing. Instagram at 2 billion daily actives, Threads past 500 million monthly actives, WhatsApp peaking at 30 million messages a second during the World Cup final. And family of apps, other revenue. WhatsApp paid messaging, subscriptions, crossed $1 billion for the first time, up 73%, an early sign of monetization beyond core advertising. Even as Reality Labs continues running meaningful operating losses on top of the AI infrastructure spend. On guidance. Meta's third-quarter revenue outlook of 61 to 64 billion came in, with its midpoint below the street's roughly 63.2 billion. Full-year expense guidance was raised to 165 to 169 billion. Full-year capex floor was raised again to 130 to 145 billion, up from 125 to 145, the third capex raise of the year. And here's how that ladder built through the year. A first-quarter run rate near 125 billion, a prior full-year guide near 135, and now a new full-year guide as high as 145. The effective tax rate was also raised for the rest of 2026. This isn't purely an on-balance sheet story either. Meta's Hyperion campus in Louisiana is being built through an off-balance sheet joint venture, 80% owned by Blue Owl Capital, carrying roughly $27 billion of debt that never touches Meta's own balance sheet. Operating margin has slipped to roughly 31% from 43% a year ago as the spend finally bites into the P&L. And the EPS miss itself wasn't really a business problem. It was two bills coming due at once. $2.4 billion in legal proceeding charges, including youth safety litigation exposure flagged directly by CFO Susan Lee, and $1.2 billion in severance tied to a May 2026 reduction of roughly 8,000 roles. On the call, Zuckerberg framed AI as simultaneously lifting the core ad business today, powering next-generation products, and opening genuinely new enterprise opportunities, and said Meta is fielding offers for its own compute capacity at a premium to what the company originally paid for it, his own evidence of an industry-wide infrastructure shortage. But when asked directly what signposts would confirm the AI spend is on track for a healthy return over the next 12 to 24 months, Zuckerberg called it a very technical question, a notably non-committal answer investors flagged immediately. CFO Susan Lee countered that the industry has structurally underbuilt for AI adoption, making Meta's existing compute capacity highly valuable regardless of near-term ROI visibility. On guidance and capex, full-year 2026 capex was raised for the second time this year to 130 to 145 billion, up from 125 to 145 guided in April, itself already raised from 115 to 135 back in January. Full-year total expense guidance climbed to 165 to 169 billion, folding in that $2.4 billion legal charge. And there's a financing wrinkle worth knowing. Meta has also been structuring some data center capacity off balance sheet, including an arrangement with BlackRock that leaves the asset manager as majority owner while Meta stays on as the anchor customer. Alongside reports it may sell excess compute to other AI labs, a way to keep the build-out running without every dollar hitting Meta's own capex line and depreciation schedule. So what does this mean going forward? On the tailwind side, core advertising is unambiguously healthy, 28% revenue growth beat estimates, with AI-driven targeting and ranking tools cited as direct contributors to impressions and pricing. A genuinely new revenue stream is forming, selling AI, compute, and APIs to other developers and enterprises, monetizing the very infrastructure that's pressuring free cash flow today. In WhatsApp and family of apps, other revenue crossing $1 billion signals real diversification beyond the core ad model. On the headwind side, capex is now growing faster than revenue. Quarterly free cash flow fell more than 90% year over year, and management doesn't yet have a clear, quantified return on investment framework to point to. Margin compression, 31% against 43% a year ago, plus the legal charges and severance costs, show cost discipline has clearly taken a back seat to the AI build-out. And those off-balance sheet financing structures, like the BlackRock data center arrangement, read to some investors as financial engineering around a true capex commitment. The sector hint: Meta is the clearest current counterexample to Microsoft's capex is paying off story. Same AI supercycle, opposite market verdict, because the cash flow math simply doesn't pencil out yet. It does reinforce demand for GPUs and memory, since component inflation was cited explicitly, while raising the bar for every other AI spender to show free cash flow discipline. not just revenue growth. Watch the third quarter for whether that 165 to 169 billion expense guide holds and whether free cash flow stabilizes. Third up, ServiceNow, second quarter 2026, quarter ended June 30th, reported July 22nd, a full week ahead of the other three. The stock rallied on the print. "We are who we said we were," CEO Bill McDermott told investors on the call. ServiceNow's AI business just crossed $1 billion in annual contract value, and agentic AI deployments and production grew 9 times over in just 9 months. The fear about AI monetization just met its answer. Against a street consensus of roughly $3.93 billion in revenue and 86 cents in earnings per share, total revenue came in at $3.99 billion, up 24%. Earnings per share, 90 cents, a clean beat against the 86-cent estimate. Non-GAAP operating margin, 29.5%, roughly 300 basis points above guidance, showing the growth didn't come at the expense of profitability. Current remaining performance obligation, $13.2 billion, up 21% and a beat of guidance by roughly 200 basis points. AI products annual contract value crossed $1 billion for the first time, and agentic AI deployment growth over 9 months hit 9 times. 123 transactions over $1 million in net new annual contract value, up nearly 40%. Evidence large enterprise deal momentum is broadening well beyond AI-labeled deals. Total remaining performance obligation reached $29 billion. And management now describes the company as operating at what it calls a rule of 56. Revenue growth plus free cash flow margin combined, with a stated path to a rule of 60 by 2030. On the call, McDermott called ServiceNow the fastest-growing major enterprise software and cybersecurity company, pointing directly to the billion-dollar AICV milestone he'd promised roughly a year earlier. Long-term targets for May's Financial Analyst Day were reaffirmed. $30 billion plus subscription revenue, 30% of ACV from AI, a rule of 60 plus by 2030, and a commitment to cut stock-based compensation below 10% of revenue by 2029. The NVIDIA partnership deepened too, with a new autonomous desktop agent called Project Arc and full integration of ServiceNow's AI control tower into NVIDIA's enterprise AI factory design. And McDermott increasingly points to cybersecurity, boosted by the Armis acquisition, as a key enterprise sales driver alongside core workflow AI. On guidance, full-year subscription revenue was raised to $15.76 to $15.78 billion, roughly 22.5% growth, the company's second raise of the year, up from $15.53 to $15.57 billion previously. The third quarter guide of $3.975 to $3.98 billion, up 20.5%, landed below some buy-side hopes near $4 billion, and third quarter CRPO growth is guided to decelerate to roughly 19.5 to 20%, down from the second quarter's 21. Analysts flagged that part of the beat came from U.S. federal on-premise deals that landed early, effectively pulled forward from the third quarter, plus that July 1st pricing change that may have accelerated some renewals. The bigger picture is escaping what got nicknamed the SaaS apocalypse. For much of 2026, ServiceNow was Exhibit A for fears that autonomous AI agents would let enterprises build their own workflows and erode demand for platforms exactly like this one. This quarter is the first time the market visibly began buying McDermott's counter-narrative, that ServiceNow is the governance layer agentic AI actually runs on top of, not a casualty of it. On the tailwind side, AI monetization is moving from narrative to booked revenue. $1 billion+ in ACV and 9 times agentic deployment growth are hard numbers, not roadmap slides. Cybersecurity has become a genuine second growth engine through the Armis integration, and federal and government AI and security spending is showing up as real, current demand, not just a future promise. On the headwind side, part of the beat was pulled forward federal on-prem deals, and a pricing change likely borrowed some strength from the third quarter, by management's own acknowledgement. Third quarter CRPO growth is guided to decelerate, and the stock remains roughly a third off its 52-week high even after this rally. With valuation skepticism near 60 times, trailing earnings hasn't fully cleared. And the AI agents will disintermediate this bear case hasn't disappeared. It's just been pushed back a quarter or two. The sector hint is constructive for enterprise software peers like Salesforce and Workday if they can show a similar ACV inflection of their own, and it further confirms NVIDIA's broader enterprise AI ecosystem strategy. But the pull-forward caveat means this isn't yet a completely clean all-clear for the SaaS group broadly. The real test comes next quarter. Sustained CRPO growth in the roughly 20% range without federal pull-forward would confirm the AICV trend is durable rather than a one-quarter artifact. And finally, SoFi Technologies' second quarter 2026 quarter ended June 30th, reported July 29th. The stock fell somewhere between 5.7 and 10%, depending on the session. Record originations, record members, revenue guidance raised, and the stock still fell because management chose to reinvest the upside rather than raise the profit outlook. 2026 is shaping up to be a defining year, and our second quarter results mark a clear inflection point for SoFi, CEO Anthony Noto told investors. Against a street consensus near $1.11 billion in revenue and 11 cents in adjusted earnings per share, GAAP revenue came in at $1.22 billion, up 43%. Adjusted EPS, 12 cents, beating the 11-cent estimate. Adjusted EBITDA, $357.8 million, up 44%, a 30% margin. Members, 15.8 million, up 35%. Loan originations hit a record $14.8 billion, up 69%. And this marked the 19th consecutive quarter of meeting the Rule of 40. Underneath the headline, that record $14.8 billion in originations spanned personal loans at $10.7 billion, student loans at $2.7 billion, and home loans at $1.4 billion. Genuine breadth of growth, not a single product carrying the quarter. Products grew 42% to 24.4 million against 35% member growth. The first quarter SoFi ever added roughly twice as many products as members, with 51% of new products coming from existing members. Net income of $156.6 million marked an 11th consecutive profitable quarter. Tangible book value per share rose to $7.34. Deposits reached $45.5 billion, and net interest margin held at 5.98%. SoFi Plus surpassed 200,000 paid subscribers after moving to a paid model, and a new engagement product, SoFi Coach, is starting to emerge. On guidance, full-year revenue was raised to $4.75 to $4.85 billion, 32 to 35% growth, above the prior street view of roughly $4.7 billion. But full-year adjusted earnings per share was held flat at roughly 60 cents, not raised despite the revenue beat, and full-year adjusted EBITDA held at roughly $1.6 billion. That gap, revenue climbing while profit guidance stayed flat, is exactly what spooked the stock. And the origination trend really is remarkable. Quarterly loan originations went from around $9 billion in the second quarter of 2025 to roughly $13 billion in the first quarter of this year, to nearly $15 billion this quarter, a genuinely accelerating pace. But this isn't a capex story the way Microsoft or Meta's is. It's a cost absorption story. Sales and marketing spend jumped 48% to $392.4 million, funding the member and product land grab. Financial services contribution margin fell roughly 600 basis points to 46%. In technology platform revenue, SoFi's business-to-business licensing arm fell 23% after a large client exit. The extra revenue this quarter is real. It's just costing more to generate. On the call, CEO Anthony Noto called 2026 a defining year, with this quarter marking a clear inflection point for the business, pointing to 35% member growth and a 42% jump in products as evidence of durability. Noto and CFO Chris Lapointe both emphasized that member spending, loan demand, and credit performance are all holding up or exceeding expectations despite broader market uncertainty, and management framed the profit guidance decision explicitly as reinvestment, incremental revenue upside redirected into growth, marketing, and new products rather than drop straight to the bottom line. On guidance, Full-year adjusted net revenue was raised to $4.75 to $4.85 billion, 32 to 35% growth, up for a prior guide near $4.66 billion and above the roughly $4.7 billion street consensus. Full-year adjusted EBITDA near $1.6 billion, adjusted net income near $825 million, and adjusted EPS near 60 cents were all held unchanged despite that revenue raise. The specific decision that triggered the sell-off, while member growth guidance was reaffirmed at 30% plus for the full year. So why did a genuine beat and raise quarter still sell off? Investors read an unchanged profit outlook sitting right next to a raised revenue outlook as margin dilution by choice. The market wanted confirmation that faster growth also drops down to EBITDA and EPS, and this quarter it didn't get that confirmation. It's the exact same pattern that played out at Meta. Growth alone is no longer enough without a matching profitability signal. On the tailwind side, record originations across personal, student, and home loans signaled genuinely healthy consumer and prosumer credit demand, a real economy data point, not an AI hype metric. Fee-based, cross-buy revenue through SoFi Plus and Coach, with 51% of new products coming from existing members, is diversifying the model away from pure net interest income dependence, and new SMB and commercial banking products expand SoFi's addressable market well beyond its consumer roots. On the headwind side, the stock fell despite beating on every single headline metric. The market is now explicitly penalizing reinvest the upside guidance, the same way it penalized Meta's capex outrunning cash flow story. Consumer lending at a record origination pace carries inherent credit cycle risk if the macro backdrop softens, and analysts flagged continued share dilution and churn in the technology platform segment as items to watch into the third quarter. The sector hint is positive for fintech and neobank demand broadly. Record loan originations argue against a recession-wide consumer credit narrative, constructive context for peers like Affirm and Upstart. But the beat without a profit raise gets sold anyway pattern, echoing Meta, is becoming a recurring theme this earnings season across very different sectors. Watch the third quarter for whether EBITDA guidance finally gets raised if current trends hold, and monitor delinquency and credit quality trends in that personal loan book given the sheer pace of originations. A second straight quarter of reinvest don't raise profit guidance would likely compound the market's patience testing reaction. Step back, and here's the pattern across all four names, sector by sector. Cloud and AI infrastructure, Microsoft. Azure demand outrunning supply, and enterprise AI monetizing fast are the tailwinds, against a 35% capex jump and margin and depreciation drag as headwinds. Digital ads and consumer AI, Meta, strong ad growth, and a new AI compute selling opportunity are the tailwinds, against collapsed free cash flow and no clear AI return on investment framework yet as headwinds. Enterprise SaaS and agentic AI, ServiceNow, AI ACV crossing $1 billion and accelerating cybersecurity cross-sell are the tailwinds, against a beat aided by federal pull forward and decelerating CRPO growth as headwinds. In fintech and consumer credit, SoFi, record loan originations and diversified fee revenue are the tailwinds, against profit guidance that wasn't raised and real credit cycle risk as headwinds. The synthesis, the AI capex supercycle, is splitting into two camps. Names where spend is visibly converting to booked revenue, Microsoft, ServiceNow, are being rewarded, while names where capex is outrunning cash generation, Meta, are being punished. SoFi shows that same growth versus profit now tension emerging even outside the AI infrastructure story, which suggests this is becoming a market-wide theme this earnings season, not just an AI spender phenomenon. So what to actually watch heading into the next round of prints? Microsoft, fiscal 2027's first quarter in October. Watch Azure capacity and growth durability, whether the guided margin dip actually materializes, and any OpenAI or RPO concentration disclosure. Meta, third quarter 2026 in October. Watch whether that $165 to $169 billion expense guide holds, the free cash flow trajectory, ad pricing trends, and product cadence out of Superintelligence Labs. ServiceNow, third quarter 2026 in October. Confirm the ACV growth isn't just federal pull forward. Check the CRPO deceleration and track cybersecurity cross-sell momentum. SoFi, third quarter 2026 in October. Watch whether EBITDA guidance finally gets. That's the full picture from this week's earnings deep dive. 4 beats, 2 rallies, 2 sell-offs, and 1 clear lesson. In this market, growth alone doesn't cut it anymore. It has to come with a cash flow story investors actually believe. Thank you for watching this deep dive from Dreamlit Equity Research. If breakdowns like this one are useful to you, the best way to make sure you catch the next one is to hit subscribe on Dreamlit Equity Research and turn on notifications so you don't miss it. We'll be back with some interesting deep dives soon. Until then, thanks for watching, and we'll see you in the next episode.